Hey everyone, it's Kevin Amos with Pine Financial Group and www.pinefinancialblog.com. I get a lot of questions in this office. Usually it's the same questions over and over. So I wanted to shoot this real quick video on some of the common questions that we get as a hard money lender. Hard money is usually from smaller companies, sometimes ex-real estate investors, so smaller companies, or sometimes even individuals that want to loan money to other real estate investors. And the cool thing about hard money lenders is they're outside the box. You know, a lot of the banks and the conventional lenders, you have to fit inside these little tiny guidelines, and if you don't fit, you don't get the loan. So with a hard money getting outside the box, it could be very advantageous for you as a real estate investor because they can maybe loan more money on a deal than what another lender would have, require less or no down payment, or if a credit situation or no income documentation. As long as the deal makes sense, the hard money lender would like to do it. Now, most hard money lenders raise their money. It's all privately raised, so they might put together an offering or a pool and let investors invest in that pool. And they generally pay their investors pretty high, pretty well. So they charge you, the borrower, a little bit more than you would pay with a bank or a conventional lender. Some hard money lenders also use debt or lines of credit. The risky thing there, or the scary thing there, is whenever you use debt, it creates some additional risk. Not only for you, the borrower, but also for the private lenders or the private money investors into the company. So whenever you create debt, there's risk. But for you, the borrower, what if that line of credit gets shut down? I've heard stories of hard money lenders having deals in their pipeline, your deal in their pipeline, ready to close next week, and their line of credit gets shut down, and now they can't fund you. So it's absolutely devastating to both them as a company and to you as the investor. Pine Financial is 100% private money, no debt. We really try to minimize our risk for both you and our investors. There's three reasons mainly to use hard money. The first one is if the house needs work. And a lot of the conventional lenders won't loan to you if the house isn't livable. So if the kitchen's in bad shape or the appliances are missing, and a lot of our clients are buying foreclosures, so the properties aren't in the greatest or the best condition. So if the house needs work, then a hard money lender could be a fantastic way to go, because the more work a house needs, usually the hard money lender gets more excited about it. If you could add value to the property by doing some work, then we can justify a higher loan amount to you. So that one reason would be because of the amount of work that you need to do to it. Another reason, if you need to close fast. You know, hard money lenders can close in a week or 2 weeks. We can close in a week if we have to. So sometimes we'll get phone calls where there's a deal, a client that has their deal all set up, their lender all ready to close, and then it falls apart because their lender backs out the week or week and a half before closing. We get that phone call, they want to use us to close. They agree to pay our points and our fees that we charge, and they end up closing on the deal. And you know what? It turns out to be a fantastic deal for them that they would have lost. They make a lot of money, and we make some money as a hard money lender by providing that service. Third reason is if you want to use little or none of your own money, and this is by far the best reason to use hard money. With a bank or conventional loans, they usually require large down payments, 25, 30% sometimes in down payments. And conventional lenders, for example, won't fund any of the repairs. So a hard money lender, especially, or at least I know Pine Financial, will loan 100% of the purchase and all of the repairs. So it could potentially be a no money down deal for you. No money down deal means higher returns, and the cool thing is it means more deals. So if you're out there finding good quality real estate deals, keep your money in the bank, use hard money, and you can do multiple deals. Qualifying is pretty simple. Most hard money lenders are going to base the qualifying on the quality of the deal. So if the deal looks like it's going to be a good profitable deal, either as a fix and flip or fix and refinance, it's profitable for you, the client, then the hard money lender is more than likely going to want to get involved. That doesn't mean it's only based on the deal. That's how it used to be. Now hard money lenders might also qualify you as the borrower. And the reason for this is we don't want properties back. We want you to succeed. The way we know you are going to succeed is if you have enough liquidity. So we're going to look at a good quality deal, and we're going to look at your liquidity. Let's say, for example, you go over your budget by 10%. If you don't have any money in the bank, you go over your budget, you're not going to be able to finish the project, and you can lose the entire deal. If you have the reserves, and we document that, you go over your budget, you cover it with your reserves, you still get the deal done. You still make your $20 or $30 or $40,000 or more. So we really want to set you up to succeed. We do look at credit and income. Most hard money lenders will, but there's very little qualification with either one of those. Credit, especially, yesterday's a bankruptcy, today's a loan. Unless there's tax liens or judgments or some other issue that could cause a problem for us down the road. So again, the two qualifying for most hard money lenders is a good quality deal and that you have a little bit of liquidity, it's a little bit of money in the bank to handle a reserve. The loan amount is usually really easy with a hard money lender. Some hard money lenders make it a little quirky and make it a little bit more confusing. I know we have some competitors both here in Denver and in Minneapolis that make it a little bit complicated. Most of them are going to be really simple. It's based on the after repaired value. These are the residential hard money lenders now. It's based on after repaired value, so whatever the house is going to be worth once it's all fixed up. And it's usually 65 or 70% of that number. So for us, it's 70% loan to value of the after repaired value. So let's say you buy a house that's going to be worth $100,000 once it's all fixed up. We're going to loan $70,000 on that deal. Now, if you could buy it for 50 or 60 and put 10 or 20 worth of repairs to get that higher value, then it could potentially be a no money down transaction. So again, it's based on the after repaired value, and usually it's 70%. The cash that you're going to need at closing can be very confusing to some people, especially because there's more fees than just what the hard money lender charges. Normally you have appraisals and you have insurance that you have to buy, and you have, you're going to get tax credits, of course, when you close, but you're going to have other third-party fees, like the county charges recording fees to record the documents. The closer is going to charge you closing fees. Sometimes you're going to have real estate closing fees and loan closing fees from the title company. And then if you have some credits or something coming back from the seller, I mean, that all can be a little bit confusing. The best way that I could tell you to find out how much money you're going to have, complete number, how much money you're going to have into a deal, is our free fix and flip app. You can get it right on our blog. It's www.pinefinancialblog.com, and up in the right hand corner you're going to see it's like an animated graphic, and it says fix and flip app, free fix and flip app. Unfortunately, this is only for iPhones and iPads. So if you have an iPhone or iPad, it's completely free, and it's the fix and flip app from Pine Financial. And that'll tell you exactly how much money you're going to have into the deal with your holding costs and closing costs. But I'm going to show you exactly how to calculate, or a real rough way how to calculate your cash into a deal. So come with me.
All right, let's go through an example here to help you understand how much money you're going to need to bring to closing. So in this example, we're going to use an ARV, or an after repaired value, of $100,000, keep the numbers real simple. That would give us a loan amount of $70,000. Now let's say you could buy this beauty for 55 grand. You have 15 grand in repairs. That's going to give you closing costs, the points of $2,800. Your other costs, this is going to include your fixed costs and all of your third-party fees, like your title fees and your recording fees. So I usually use $1,500 to $2,000. In this example, I'm going to use $1,500. Okay, so if you combine all four of these numbers, that's going to give you your debits. You're going to need $74,300 to get this deal closed. Okay, the loan amount again is $70,000, so the difference, real simple, $4,300 is the cost to get the deal closed. So again, you take your purchase price plus your repairs, and then all of your closing costs, which is 4% of the loan amount, plus $1,500 to $2,000. You take all of those added together, subtract your loan, and that's how you calculate the amount you're going to need to close.
So the payments on a loan are really easy to calculate with hard money lenders. It's almost always simple interest. Most good hard money lenders are going to require monthly payments so that we know if there's a problem immediately. If you miss a payment, we're going to know there's a problem. Some hard money lenders will require that you pay all of the payments right up front, or some will defer them to the end, which I think is a mistake, and it's a disservice to you and to their investors, their private money investors. So what I'm going to speak about is if your hard money lender requires monthly payments, here's how you calculate it. Now for Pine Financial, it's 15%, so I'm going to use that as an example. Come with me, let me show you how to do it.
Okay, to calculate a payment, let's use the same examples we did earlier. $70,000 loan, we just multiply that by 15% interest to give us an annual payment. So our annual payment is $10,500. We divide that by 12 months, and we get $875 per month.
Okay, so now you know what hard money is and what hard money lenders do. You know when the good time is to use them, which is actually pretty frequent because little money into a deal is obviously and oftentimes advantageous for you. You know how to calculate your payments, you know how to calculate how much money you're going to need to get a deal done. So now you need to know what the next steps for applying are. I can only speak about Pine Financial. I make it really simple. Again, if you're in Minneapolis or if you're up and down the Front Range in Colorado, you go to our website, www.pinefinancialblog.com, and you, on the right-hand side, about halfway down, there's a button that says Apply Now. You click on that and you fill out the application. A couple cool things here is it's 100% completely free to apply. It doesn't cost a dime. I don't charge you application fees or credit report fees or anything. And I actually can issue you loan commitment letters based on that qualification without charging you anything. So you can go out there and make some offers. And you don't have to pay a dime until you get a deal. I want to say thank you for taking the time to watch this video and hope to see you out there.